Welcome back to Acceleron Learning and our discussion on the structure of a loan. It's important to understand how the number and frequency of loan payments can impact the interest. This is because of how the interest will be calculated or compounded. To simplify the explanation, let's assume the interest rate stays the same or is a fixed rate of interest. Methods of compounding include lump sum. In this case, the interest is calculated once on the full amount of the loan, and the loan is then paid back all at once. Quarterly. Payments are made every 3 months, so the interest cost will change every 3 months because the principal amount changes every 3 months as well. Monthly. Payments are made every month. The principal amount changes every month, and therefore the interest cost changes each and every month. This is the most common type of payment schedule. Semi-monthly. Payments are made on the note twice each month for a total of 24 payments each year. This is not a common note payment schedule. Generally, payments are made on the note every 15 days. A bi-weekly payment schedule is not the same as a semi-monthly schedule, though it can appear to be since the payments are made every 2 weeks. However, this means that 2 months of the year will require 3 payments within that month because the schedule requires payments every 14 days rather than every 15 days. The type of payment schedule required will vary based on the lender, the type of loan, and the borrower's credit risk, but a monthly payment schedule is the most common. As I said earlier, amortization is the process of paying off a debt over time through regular periodic payments. A portion of each payment is for interest, while the remaining amount is applied towards the principal balance. The schedule details the expected amount of interest and principal payments each period, assuming the loan is paid according to the original schedule. A schedule can have equal monthly payments with different final balloon payments, or equal monthly payments with all payments for the same amount. An amortization schedule will vary from the original if payments vary from the original schedule. Late payments will increase the amount of interest paid and decrease the amount towards the principal. Early payments will decrease the amount of interest paid and increase the amount paid towards the principal. Finally, it will vary if additional payments are made and applied towards principal. Interest costs will decrease and the loan will be paid off faster. Exactly how is a loan payment calculated? Let's use a car loan as an example. Assume the cost of the car is $22,000. The down payment is $2,000 and the amount financed is $20,000. The interest rate on the loan is determined to be 8% based on the lender's assessed risk of this particular loan, and the repayment period is 5 years or 60 months. The borrower can expect to make 60 equal monthly payments of $405.53. So how do we get to this payment amount? By using the standard algebraic formula for an annuity, which is what a loan payment is shown as on the slide. For this formula, R equals the annual rate divided by the number of annual payments. In this example, the monthly rate is 0.08 divided by 12, or 0.00667. N equals the number of payments to be made, which is 60 in this example, and P equals the principal amount financed, or $20,000. So the monthly payment of $405.53 can be calculated by plugging this monthly rate into the standard formula and multiplying the principal amount of $20,000. So that's how we arrive at the payment of $405.53. And don't worry, they'll calculate this for you. But if you'd like to do it yourself, don't forget to divide the annual rate by the number of payments per year. Otherwise, the loan payment will be way out of your budget. What would the amortization schedule for this loan look like? The payment amount will be the same every month, but notice that the principal and interest amounts change each month. This is because borrowers only pay interest on the actual amount of principal outstanding, and since this amount declines each month, so does the monthly interest cost. Here's a practical tip when buying a car. When taking out a car loan, be aware that dealers will ask what monthly payment you can afford rather than asking what your total threshold for borrowing is. Then they will tweak rates, frequency, and number of payments to arrive at a monthly amount you're comfortable with and ignore the true total of the amount borrowed. Always set a maximum loan amount before talking about payments. Let's review the note on that car you just bought. Your interest rate on the 5-year loan is 8% per year, which is the same as 0.00667 a month for 60 months. We use the standard formula for calculating an annuity payment to determine that the monthly payment on the loan is $405.53. When we multiply the monthly payment amount by the number of payments, or 60, we get a total of $24,331.80, which is the total amount paid over the life of the loan. Since the principal amount was $20,000, the additional $4,331.80 is the interest paid on the note. The total cost of the car is $22,000 plus $4,331.80, which comes out to be $26,331.80. So why do we add the interest to the $22,000 amount instead of $20,000? Because we need to include the down payment as part of the cost. The full price of the car was $22,000, and we paid this price using a combination of cash and financing. Interest costs as a percentage of the total original price of the car is $4,331.80 divided by $22,000, or 19.69%. What can we conclude from all of this? Well, that financing increases the overall cost of the purchase. About 20% of the final cost of the vehicle is attributed to financing charges. I guess you'll need to buy a house too. Otherwise, where will you park the car? Let's see how much a house really costs using our newly developed expertise in finance. A home costing $275,000 purchased with a $25,000 down payment and a 30-year 6% fixed-rate mortgage will require a monthly payment of $1,498.88 on a principal balance of $250,000. If the home is purchased on December 1st, 2012, the first payment will be made January 1st, 2013. Why is this? Because a mortgage is an annuity, and regular annuities are paid at the end of a period, not the beginning. This means you pay the interest on the note after you use the money for the month, not before. At the end of 5 years, or 60 months, you will have made a total of $89,932.58 in payments, of which $72,568.47 of that will be interest payments. Why does so little go to pay down the principal? Well, this is a function of the amount borrowed and the interest rate. The beginning of the note is when you are using a lot of someone else's money, and the interest rate is what it costs you to do that. As time passes and you use less and less of the other person's money, the cost of using the money decreases. So what is this house really going to cost me? The total cost of interest on this home purchase will be more than $289,000 over the 30-year life of the loan. Since the interest on homes is tax deductible and so are the property taxes, you do get a little help by way of a reduced income tax bill. And interest costs can be reduced with a little bit of effort. Did you know that by adding a payment of $100 per month towards the principal will reduce the required payments from $360 to $306 over the life of the loan? And the interest costs over the same life will be reduced by more than $238,000, a savings of more than $51,000 overall. Still, the cost of borrowing can be pretty high, so why would anyone do this? Homeownership has long been considered a hedge against inflation, as home prices have generally kept pace with inflation in the economy. For instance, a home costing $250,000 today cost about $25,000 in 1963, according to the Case-Shiller Index. Homeownership is also thought to create more stable neighborhoods with lower crime rates. And who wouldn't want to customize a home exactly the way they want it? Loans are a key component of personal and business life, allowing you to obtain goods and provide business growth and liquidity. To recap, loans are transactions made between a borrower, who can be an individual or business, and a lender, which can be a financial institution such as a bank or an individual. Liquidity is another word for funds that are accessible and available to meet regular operating requirements. Usually, the borrower requires a loan because there is a purchase or other immediate financial need for which the borrower does not have sufficient liquidity. The amount of money that is borrowed is called principal. For providing the money to the borrower, the lender will charge a fee called interest. The loan is an obligation of the borrower to the lender and requires repayment over some agreed-upon period of time. However, there is more to a loan than the amount of the down payment and the monthly amount of the payment on the note. How can you know when it is appropriate to borrow? Ask yourself a series of questions before signing that note. 1. Make sure you absolutely need to borrow. Can the reason for the loan be delayed? Can you save enough money in a reasonable time period to pay with your cash? Is this need worthy of utilizing a portion of your credit versus potential future needs? Identify the type of loan that best suits your needs. For short-term needs or items with limited useful life, look for short-term loans. For longer-term needs or items with an extended useful life, look for a longer loan. Number 3, understand the true cost of the loan. Know your credit score, as this is an important determination in both the likelihood that you will receive the loan and under what terms and conditions it will be granted. Know alternative or competing sources for similar types of loans, and establish a relationship with your bank, as this will make it easier to obtain a loan. Number 4, make sure you can afford the loan. Know whether the interest rate is fixed or variable and whether the repayment terms are fixed or variable as well. Know whether you will be charged application or processing fees and how much will you be charged if your payment is late. Know whether you can repay the loan early without a penalty fee. Know the consequences if you can't. Know your alternatives, including selling assets or refinancing if you can't. Number 5, shop for the best deal. You're still a customer, so look for the best terms possible. If there is any question about whether you can afford to repay the loan or not, don't take it out. And that's what you need to know about the structure of a loan. Acceleron Learning, life experience accelerated.